Hello, everyone. Good morning, good afternoon, and good evening to all of you. And thank you all for joining in. I'm Garima Tandon from Quantitative, a pioneering algorithmic and quantitative trading research institute, where we are empowering individuals across 160 plus countries through our educational initiatives. Now, I will quickly introduce you to the speaker and then let him take over the presentation. Our speaker for today is Zura Kakushadze. He did his PhD in theoretical physics from Cornell University at the age of 23 and was a postdoctoral fellow at Harvard University post then. After expanding into quantitative finance, he was a director at RBC Capital Markets, managing director at WorldQuant, executive vice president and substantial shareholder at Revere Data, an adjunct professor at the University of Connecticut. Currently, he is the president and CEO of Quantigic Solutions and a full-time professor at the Free University of Tbilisi, Georgia. He has over 17 years of hands-on experience in quantitative trading and finance. He has over 130 plus publications in finance, physics, cancer research, and other fields, including the paper 101 Formalic Alphas and the book 151 Trading Strategies. And so this is it from my side. Let's start with the presentation. Zura, over to you.
Thank you. Let me share my screen. I hope everybody can see it. Thank you for the introduction, and I'll just dive right into the presentation because we've got a lot of ground to cover. So suppose you're sitting there and you're trading 2,000 of the most liquid US stocks. So you're managing your portfolio and you want to optimize it. Now, if you're trying to use some kind of optimization technique such as mean variance optimization, Sharpe ratio maximization, and whatnot, under either of those circumstances, you need to calculate somehow the inverse of the covariance matrix in order to get your desired dollar holdings in your portfolio. Now, the inverse covariance matrix can be either calculated or modeled in various different ways. And if you try to do this as a inverse of a sample covariance matrix, then you're going to run into a slight trouble. Now, the trouble is that if the number of observations in your time series of returns based upon which you calculate your sample covariance matrix is smaller than the number of stocks in your universe, then your sample covariance matrix is singular. You can't invert it. Now, that's only half of the trouble, though, because even if somehow you had enough observations in your data sample, and if your sample covariance matrix were to be non-singular, it's still not enough because the off-diagonal elements, meaning basically the correlations in your sample covariance matrix are highly unstable out of sample unless the number of observations in your time series is much greater than the number of stocks in your universe. And that's basically never the case in real life applications. So to understand why and to understand why that issue arises, let's look at a typical liquid portfolio of US stocks, for example. Then you're talking about say somewhere between depending upon what kind of strategy you're trading, somewhere between say 1,000 to 2,500 or even higher than that number of stocks. And even if you took a 5-year look back in terms of daily observations, you would have a relatively small number of observations in your time series, and therefore under those circumstances, basically your sample covariance matrix would a lot of times be singular, and even if it were non-singular, it would be highly unstable out of sample as far as the correlations are concerned, or the off-diagonal elements of it. So in the case of quantitative trading strategies, which have shorter holding periods and typically tend to be quite short-lived themselves. In other words, those ephemeral alphas that you figure out an alpha, and then you trade it for 3 months or 6 months, and then a lot of times it might just die, and then you have to replace it with some other alpha. And so in those cases, long lookbacks are not even desirable, because for quantitative trading strategies of that kind, what happened 10 years ago is not particularly relevant for what's going to happen tomorrow. Your lookbacks typically are supposed to be much, much shorter for them to be relevant and adapted to the current market state, rather than whatever was happening 10 years ago, which is a very different type of market, right? And so for quantitative trading strategies, this issue is even more exacerbated. And therefore, what you need to do is you need to come up with some kind of a replacement for the sample covariance matrix. So in practical applications, the way it is typically done is that instead of using a sample covariance matrix, you use some kind of a model covariance matrix. And a typical way of modeling a covariance matrix is through a factor model. So the idea with the factor model is that you decompose your risk into basically two pieces. The first piece is the factor risk, which is common for all stocks in your portfolio. And the number of factors, which I call K here, is assumed to be much smaller than the number of stocks in your universe. So if the number of stocks in your universe is 2,000, then you might have, say, 100 factors. And I'll get later to describing some of those factors. And so the number of underlying factors is smaller, and so you basically describe a big chunk of the risk space using these underlying factors. And then there is the leftover piece, which is called the specific risk, or idiosyncratic risk, depending upon who you ask. And that piece is basically diagonal. It's pertinent to each stock in your universe. And that diagonal specific risk piece is something that cannot be explained by underlying factors. It's basically noise pertinent to each individual stock. Now, this way of modeling the covariance matrix, which is a factor model, has the advantage that at the end of the day, what you need to calculate is the factor covariance matrix, which is a much smaller matrix, which is a K by K matrix, than the original sample covariance matrix, which was the N times N matrix. So if the number of factors is small, then you're basically modeling the large 2000 by 2000 matrix by a much smaller factor covariance matrix. And so if you are able to calculate your factor covariance matrix, then by the definition of the factor model that you see on your screen, that factor model matrix is actually explicitly positive definite and therefore invertible. So that's a pretty convenient and efficient way of solving that problem, modulo a few things that I'm going to mention down the road that you still have to deal with. The devil is in the detail, obviously. So modulo those things, this is an efficient way of basically dimensionally reducing your problem. So before I actually dive into the details of how to proceed with this type of a dimensional reduction, a few important observations are in order. First of all, if I look at the sample covariance matrix, I have basically the correlation matrix multiplied by a product of standard deviations, which are the square roots of the sample variances. And so the volatilities, the sigmas, they are computable. In other words, I can calculate the sample variances, and there is essentially no issue with calculating them. They're not the ones that make the sample covariance matrix singular. It's actually the sample correlation matrix that's singular. That's point number one. Point number two is that the sigmas cross-sectionally have a skewed distribution, a very long-tailed skewed distribution. It's roughly, not exactly, but it's roughly log normal. So basically, these sigmas are very skewed from one stock to another to the third, and you don't want to try to model that skewness, because that skewness has nothing to do with the issues that I mentioned above, which is the singularity of the sample correlation matrix, instability out of sample, and so on and so forth. So what you really want to model is the sample correlation matrix. You want to factor out these skewed variances out of the sample covariance matrix and focus on modeling the sample correlation matrix. That's what you really want to do. And so once you factor those things out, all that skewness and all that long-tailed inconvenience goes away. And so what you're really modeling, it's a factor model, which I have here for the psi in green. It's a factor model for the correlation matrix, not a covariance matrix. And then what would be the specific risk in that language, these psi's, they're actually fixed by the requirement that the diagonal of the correlation matrix should be all ones, right? The correlation of the stock with itself, it's one. So that actually fixes what your size should be. And then you can relate your original specific risks and factor loadings matrix in the formula that I have in the orange above, just by multiplying by these factors of sigma, which are the historical standard deviations. So moving forward, we're always going to be talking about modeling a sample correlation matrix via some kind of a factor model, not the sample covariance matrix, okay? So now, then the question arises, what should the risk factors be? That's to say, what should these factor loadings be? What should the columns of these factor loadings look like? And so you have some number of choices. One thing you can do is you could say, okay, let me take the sample correlation matrix, and let me take some number of its principal components as the factor loadings matrix. That's a pretty natural thing to do. It's a simple thing to do because it's easy to calculate those eigenvectors or principal components. One of the issues is that the number of the eigenvectors that you could possibly use is limited. It's limited by the number of observations. So if your look back is small, then the risk space coverage that you're going to attain this way is relatively limited. So that's one thing to keep in mind. Another possibility is to consider the so-called style factors, which are basically stocks' estimated measured properties, such as you could think of style factors such as size, which is related to the market cap, value, growth, momentum, volatility, liquidity, and that kind of factors that you would calculate from some kind of measured properties of the stocks in your portfolio. However, the number of such style factors is also limited. Something that you can reasonably write down is maybe at most 10 or of that order of magnitude. And once you go to short horizons, that number is even smaller. It's like something like 3 or 4 factors you can write down reasonably that are pertinent to short horizon models. And I'll talk about this a little bit later. To contrast with this, there are ubiquitous industry factors you can use. So, for example, you can take your favorite fundamental industry classification, such as GIGS, BIGS, or some other, and typically such classifications have a hierarchical structure where here the one that I have written down pertains to Bloomberg industry classification, where the least granular level in your classification is called sector. So you take your entire universe of stocks and group it into 10 sectors. And these groupings are done using some kind of fundamental considerations that I'll touch upon later. And then sectors are broken up into more granular industries, and then industries are broken up into even more granular sub-industries. And the sub-industry level for a typical universe, you will have a few hundred sub-industries. So if you base your risk factors on these sub-industries, you're going to have actually a few hundred risk factors that way, which is a lot higher number than you would get with style factors or principal components for short horizon lookbacks. And so that's a step up in terms of the number of factors. And then yet another possibility is to say, okay, well, if I'm going to use some kind of a classification type of way of constructing my risk factors, then I can mimic that basically by using clustering techniques from machine learning. And I can take the underlying returns from my original time series data. I don't have to look at the industry classification or anything like that. And I can just cluster my returns using some kind of clustering techniques. I can even build a multi-level clustering scheme which mimics a fundamental industry classification. And that way I can actually, in theory, have many risk factors constructed that way. So that's another possibility. And we'll talk about all of the above in this presentation. So let's start with the style factors. The thing about style factors is that if you look at the longer horizons, you might have some style factors such as growth, for example, which might be relevant. However, once you start looking at shorter horizon strategies such as intraday strategies or your typical stat arb, we say 1 to 20 day holding period stat arb, then some of those longer horizon factors are no longer relevant because you're working at much shorter horizons. And so if you're trading something intraday, what happened, 3 months ago with the earnings announcements, it's not particularly relevant. And so you have this issue that if you try to use these style factors, which are not relevant to your shorter horizons, to your quantitative trading alphas, then you got a problem. And the problem is this, that these irrelevant factors, they create noise in your optimization. Now, naively, one might say, oh, well, it's noise, who cares? It's just random stuff, and so no harm, no foul. However, that's not quite true. What happens is that noise generates additional trades in your portfolio, which basically have no alpha behind them. And this overtrading in real life, while it doesn't cost anything on paper, in real life, it actually costs money because you have to trade more. And so it actually hurts your portfolio. So one lesson from this is that if you're trading your shorter horizon strategies, and if you want to use some kind of a risk model, what you really need to do is you need to exclude longer horizon factors and focus on the shorter horizon factors that are relevant for your trading. Another issue is inadvertent alpha neutralization. So suppose you have a factor in in your risk model that is something that you actually want to be long. For example, suppose your alpha by design is skewed towards small cap value. So if you're going to take a standardized risk model, which you are going to use in your optimization, and by a standardized risk model, I mean a risk model that you would go and say buy from a vendor that was built for purposes of long horizon type of strategies, then that risk model will have a size factor in it for this particular example, which will neutralize your alpha, because the optimization / regression in which you are going to use your factor model or your risk model essentially either completely or approximately neutralizes your alpha against the risk factors. And so that's no good, because you don't want to neutralize that particular factor that you want to be long. And so that's an issue. And so you need to be able to remove these undesirable risk factors from your factor model. However, that requires to recalculate the factor covariance matrix and specific risk based on the subset of the risk factors. And you cannot do this in a standardized risk model. You just don't have that option. So you have to build it from scratch yourself with a smaller number of factors. Then there is another issue that when you're trading your quantitative alphas with a custom universe that you have, if you try to apply standardized risk models, you got a problem. Now, the problem is that standardized risk models, they all have basically a fixed number of what I call cookie cutter industries. And those cookie cutter industries have reduced industry granularity, which basically does not cover enough of your risk space. And so that's an issue. You want to cover the relevant directions in your risk space, which, for example, if you took your industry classification and built those risk factors yourself from scratch, like GIGS or BIGS or something like that, then typically you will have a larger number of true industry factors constructed that way based on, for example, sub-industries in BIGS, that then the number of cookie cutter industries that you would get from a standardized risk model. And so that already tells you that using a standardized model probably is not good for you, and you should be building something from scratch, meaning a custom risk model. So how do you build these custom risk models from scratch? So I already mentioned principal components, and so let me start with that. So one way is to build the so-called statistical risk model. So what are statistical risk models? Basically, you're saying, okay, let me take my time series of returns, and I have a look back T, which is relatively limited because, as we discussed, you don't want to have a very long look back, considering that your strategies are short horizon and you don't want to be going back too many years into the past. So your look back T can be quite short. Now, the idea here is that your factor loadings, these betas, should be just based on the time series of the returns. As a matter of fact, recalling that we're actually modeling sample correlation matrix, not a covariance matrix, what you're actually working with is not the returns themselves, but the normalized returns. So you take the returns and you divide them, you factor out the sample standard deviation of historical returns, and then so these are twiddles here are these normalized returns. And so what you want to do is you want to have your betas built as some kind of combinations of these returns. And the question is, what are these combinations? And the answer is, well, I can take the first k principal components of my sample correlation matrix itself and use those as the columns in my factor loadings matrix, meaning beta. So then the question becomes, okay, so what should this k be? What should the number of principal components that I use as my risk factors in my factor loadings matrix? What should that k be? And you can do a lot of very complicated and convoluted things in this regard, and make your life very complicated with very little to show for it at the end. And so my point is, keep it simple. Keep it, make it such that it makes sense, that there's some kind of a reasonable intuitive understanding of why you're using that many risk factors and not some other number, right? It has to be something that makes sense, basically. And so I'm going to give you a one prescription that I like quite a bit because it makes a lot of sense to me. You can use the so-called effective rank. So what's effective rank? Now, it's something quite simple, as I will explain in a second. And these guys wrote it up in some signal processing conference proceedings. If I had to guess, I would imagine that Euler knew what effective rank was back in the day. However, Euler never wrote that paper, and these guys did, and so credit goes to them. So what is effective rank? Effective rank is an effective dimensionality of a matrix. So basically, you take your sample correlation matrix, and you're going to ask the question, how can I define its effective dimensionality? So its rank, you already know. The rank is T, where the T is the number of trading days, for example, in your look back. And so the rank of that matrix is going to be T minus 1. However, that's not the true effective dimensionality of that matrix, because if you look at the eigenvalues of your matrix, some of them are going to be large and some of them are going to be much smaller. So you know that it's, like the effective rank should be something between 1 and T minus 1. And so the question is, what is it? And so you can define it. And instead of writing down a bunch of formulas, I actually wrote down for you some R code, which is very simple. I could have written it in one line, but I broke it down into 4. And so if you take that R code, it calculates for you what this effective dimensionality of the matrix is. So the matrix is psi, and then it's a square n by n matrix. And at the end of the day, it uses spectral entropy to define the effective dimensionality, or the E rank. So now the limitations of using statistical risk models, as I mentioned before, is that K, the number of risk factors that you're going to get this way, is limited by the number of observations. So you're actually going to use a subset of your principal components, and the number of principal components with non-zero eigenvalues is T minus 1. So your K is always going to be some number between 1 and T minus 1. It's going to be less than T minus 1. So if your look back is short, imagine your look back is like 21 trading days, for example, 1 month, right? Or even if it's maybe a couple of months, if you go that far, then that K is going to be relatively small. It's going to be something like 10, 20, or something like that. And so depend upon your time series of returns. And therefore, you're going to be covering a relatively small part of your risk space. Your risk space is, 2,000 dimensional. And the question is, how much of it do you really want to cover? And that's the factor model. And this factor model is going to cover a relatively small percentage of that risk space. Another issue with this is also the instability out of sample, which is the higher principal components of the sample correlation matrix are notoriously unstable out of sample. And that instability is related to the instability of the off-diagonal elements, in other words, of the pairwise correlations in the sample correlation matrix to begin with. So, you take a sample correlation matrix, which is a bunch of ones on the diagonal, and off diagonal some pairwise correlations, and those pairwise correlations are unstable out of sample. Then you calculate a bunch of principal components out of this correlation matrix, and that whatever you've calculated out of the unstable correlation matrix in itself is going to be unstable. So the higher principal components are unstable. The first principal component is relatively stable. As a matter of fact, when n is relatively large, then your first principal component is approximately 1 over square root of n. And the reason why is because the first principal component basically describes the market mode, the movement of your stocks in your universe as a whole. So the first principal component is relatively stable, but the others are not. And so that instability is there in your factor model. Okay. Now, I've drawn a picture of what E-rank is like in terms of illustrating it. If I take a simple model where I assume that my sample correlation matrix is just uniformly, it's a bunch of uniform correlations, then if I plot the E-rank, this is what I'm going to get in terms of the plot for it. So that gives you a feeling of what it looks like. Now, what I've plotted here is the E-rank for a 100 times 100 correlation matrix, and I'm varying the correlation row from 0 to 100. So if the correlation is 0, then the rank of the matrix is 100 because it's just a unit 100 by 100 matrix. As I grow the correlation and it goes to 1, when the correlation is 1, when everything is 100% correlated with each other, then the rank of this matrix is 1. And so the E-rank smoothly interpolates between those two regimes. So that's just to give you a feeling of what E-rank looks like. So now the next thing that we mentioned before was the style factors. So what can we write down in terms of the style factors? Now, as I mentioned, we want to focus on style factors that are particularly relevant to short horizons. So we don't want to talk about things like, for example, earnings or value or growth that would be particularly relevant for longer horizon models, but we want to focus on shorter horizons. And so for shorter horizons, you can actually write down relatively few things that make sense for shorter look back and shorter holding strategies. And even with those, you actually have a few things that you will have to tweak a little bit. For example, if I look at a typical size factor, how do you define size? You take market cap and take a log of it. So if I take market cap and log of market cap, I can decompose into two pieces, which is log of the price plus log of the shares outstanding. Now, the shares outstanding don't change a lot. So if you're trading, for example, an intraday strategy, shares outstanding has it's basically statistically insignificant correlation with anything you're going to do with your alpha, because those shares outstanding change once in the blue moon, and they don't change a lot, and so it's not particularly relevant for your shorter horizon alpha. So you can drop the shares outstanding, which is that noise that I mentioned before, And so your size then becomes log of the price. So that might sound a little surprising, but that's what it is for shorter horizons. It's actually log of the price. Then you can define momentum. There are many ways of defining momentum. One way I have written down, which is previous close divided by previous open, and log of that. So that would be your momentum factor. The next thing you can define is volatility. Again, you can define volatility in a variety of ways. For example, you can look at some short look back historical volatility of close-to-close returns, or you could define something along the lines of what I've written here, which I call the intraday volatility, which is defined using the high-low difference versus the close. And you have to average over some number of days because it's pretty noisy. So in order to eliminate the noise, the relevant noise, you have to average over some number of days. And so that mean is defined, for example, over the past 21 trading days, which is 1 month. Now, liquidity typically is defined as log of the average daily dollar volume. And you can play the same kind of a trick with the average daily dollar volume, basically assuming that the prices are not jumping up and down too much, they're not changing a lot. It's actually the change in the average daily dollar volume is mostly coming from the volume, not the price. Assuming the prices are relatively stable, then you can approximate the average daily dollar volume, or log of that rather, as log of the price plus log of the average volume over the same period. And log of the price is already part of your factors. It's the size factor, which we discussed just a second ago. And therefore, your liquidity factor becomes just the log of the average volume. And then that average you can take, for example, again, over the past 21 trading days. It could be 10 days, it could be 21 days, it could be 30 days. It doesn't really make much of a difference. But basically, these 4 factors are pretty much the ones that you would be writing down for your short horizon factors. And so now you can ask yourself, well, how do I know whether they add value or not? And one way to understand whether they add value or not is to run the so-called Farmer-Macbeth regressions and calculate annualized serial t-statistics. So the way you do this is, I'll give you one way of doing it. So you take overnight returns. So the overnight returns are basically, you can define them as the log of the open versus the previous close. And as your loadings matrix, you're going to take the 4 factors that I just discussed a second ago, plus the intercept. So you have to add the intercept. And then you run a cross-sectional regression of your overnight returns over these factor loadings. So you have 5 columns in this factor loadings matrix beta. And so this way once you run the regression, it's going to produce 2 things. One thing that it's going to produce is the factor returns. So it's going to produce a time series for each of these 5 factors, which I call these F sub A's. And then it's going to also produce the residuals. So let me focus on the factor returns. So for the factor returns, what you can do is you can calculate the annualized t-statistic. And the reason why this is relevant is because basically you can ask yourself a very simple question. You can say, okay, well, how do I know these factors are statistically relevant? And if you look at an annualized t-statistic and an annualized t-statistic, which is basically annualized Sharpe ratio, if you thought of these factor returns as factors that you might want to bet on, then if that Sharpe ratio is basically above 3, then you know that yeah, I mean, a reasonable person might consider betting on such a factor. And if it's much lower than 3, then that's probably just noise, and you don't want to include that. So that's a way of testing that. Another way of testing it is to base your intraday trade or some kind of short horizon alphas on the residuals. So what you do is you say, okay, well, I know how to calculate my factor loadings the way I just described, and so I'm going to use these factor loadings to factor out the factor returns out of my historical returns, like in this case, overnight returns. And I'm going to trade on the residuals. So I'm going to take bets opposite to the residuals, which is alpha basically is the negative with some normalization factor of the residuals. And so you can run that back test and you can verify that you can look at the factors and see which ones add value, which ones add less value, and so on and so forth. So that's another way of kind of running a sanity check on the Farmer-Macbeth regressions. And here I have given some data from such backtests. And one thing that I'd like to emphasize here is that if you look at such backtests with the factor where your factor is just the intercept versus intercept plus the 4 factors, and you see that the 4 additional factors that I've discussed before, which are price, momentum, the volatility, which is denoted as HLV, and the volume factor. So those 4 factors definitely add value. However, if you just said, okay, let me just take BICS sectors, which is the least granular level, and if you wanted to go to the most granular level, the gap would be even larger. But even at the least granular level, if I just look at the BICS sectors on their own actually outperform any of these style factors. And if you took the BICS sectors and added the style factors, you get a small improvement, but it's not it's not make it or break it. So BICS factors already at that least granular level, they add a lot more value than the style factors. So that actually tells you something. It tells you that you have to be careful with style factors in terms of the amount of value you can expect from them. And I'll talk about this in a second. So I just plotted those results from the previous slide also in terms of the P&Ls, in terms of comparing, and there's this gap between using just the style factors and then jumping to BICS, and then between BICS and BICS plus style factors, you get a small pickup. So that brings us to risk factors based on industries or sub-industries, if you want to go to the most granular level. So how do you do this? How do you construct a risk model based on a bunch of industry data, fundamental industry classifications such as BICS, GICS, or something else? And as we discussed before, the number of sub-industries on the most granular level can be a few hundred. So their number is a lot larger than the number of style factors that you can possibly write down, or relevant style factors that you can possibly write down. So you are going to be covering a lot bigger chunk of your risk space with industry factors like this. So the way to construct these is as follows. So remember, we were talking about statistical risk models and how the principal components beyond the first principal component are not stable out of sample, but the first principal component is relatively stable out of sample. So suppose you have an industry classification such as BICS, and somebody just popped a question here. What is BICS? It's Bloomberg industry classification. So, and GICS is the Global Industry Classification Standard. So, you can take any industry classification you want, as long as it's well built and reasonably granular. So you can, there are industry classifications out there that are not particularly granular and not particularly well built, and so you don't want to use them in real life trading. But so let's take a relatively granular industry classification. Let's go down to its most granular level, which I'm going to call sub-industries following BICS or GICS terminology. So I have 2,000 stocks, and say I have a couple of hundred of these sub-industries. Each sub-industry basically defines a block in my correlation matrix, in my sample correlation matrix. So I carve out a block corresponding to that sub-industry. So for example, that sub-industry contains maybe 20 stocks, okay, just as an example. So I have a 20 by 20 sub-matrix, which I call this psi A sub ij, of my sample correlation matrix. I take the first principal component of that, and then in terms of the factor loadings matrix, the beta I sub A, for those 20 tickers, for that specific value of A, which is the label for that particular sub-industry, for those values of beta, I'm going to take the first principal component of that sub-matrix, 20 by 20 sub-matrix, as the column in that factor loadings matrix. So that gives you a prescription of how to construct the factor loadings matrix, and that defines your risk factors. Now, the issue with this is that you get the embarrassment of the riches type of thing going on here. And what I mean by that is that your factor covariance matrix, if you calculate as a sample covariance matrix of risk factors, is going to be singular for any kind of a short look back, because you have too many sub-industries. So if the number of sub-industries is, say, 200, right, or something like that, and then you don't have enough observations in your look back, then that's going to be singular. And even if you did have somehow enough observations in your look back, then again, it would still be relatively unstable out of sample. So, you're kind of like, because of the number of risk factors that you have included, you're kind of, dealing with the same problem that you started with, but it's just a smaller problem. So you started with a problem that was a 2,000 by 2,000 matrix that you didn't know how to calculate properly. So now you've reduced it to a 200 by 200 matrix, but you kind of still don't know how to calculate it properly, except at the smaller matrix. So the way to solve this problem is suggested by this hierarchical structure of industry classifications to begin with. And that's where this so-called Russian doll risk model embedding comes in, whereby you start with a 2,000 by 2,000 matrix, you make it smaller, you reduce the problem to a, for example, 200 by 200 matrix, but you still need to calculate. And then you take those risk factors, which are the factors corresponding to the sub-industries, and you model them with yet another risk model, yet another factor model, for which the new risk factors are actually based on industries, which is the next least granular level. So, for example, you would have something like 50 industries, and so you have a 200 by 200 matrix, and you model it as using a 50 by 50 factor covariance matrix at that step. And so now you've reduced your problem to a 50 by 50 matrix that you need to calculate. So at the next step, you could say, okay, I don't want to calculate a 50 by 50 factor covariance matrix using a sample covariance matrix, but I want to model it again. And the way I'm going to model it again is that I'm going to model it via a factor model, which is a which is for which I'm going to use sectors, is I'm going to use sectors for my for modeling that. So my new sectors are going to be my new factors are going to be based on the sectors, and the number of sectors in, for example, in VIX is 10, and some other risk model it's going to be something else, maybe 11, but it's a small number. It's of order 10, and so now I can say, well, I mean, I probably should be able to calculate a 10 by 10 factor loadings matrix as a sample covariance matrix. And if I can't, I can go one step further. I can actually build a one-factor model for that, which is basically the single remaining factor is the market, meaning it's the whole universe of your stocks. And so I can start 2000 by 2000, reduce it to 200 by 200, then I can reduce it to 50 by 50, 10 by 10, and eventually I can just move it down to 1 by 1, and then once I remove it to 1 by 1, that's just a factor. That's just a 1 by 1 matrix, and 1 by 1 matrix is simply it's a variance. So I'm definitely able to calculate the variance. Okay. So that way I can reduce my problem in a stepwise fashion, and I can calculate I can build my entire model via these nested embeddings, and I calculate the entire factor model for my sample. So I approximate my original sample correlation matrix. Now, I can actually include style factors into this construction. It makes the math and the construction slightly more convoluted. It can be done. However, again, the number of style factors that you're going to include is going to be relatively limited. And so that's, something to keep in mind. As a matter of fact, the way to think about the style factors in this context is that you can ask yourself a question, because the number of style factors is, say, it's going to be something like 4 or something around that number. If the number of style factors is so small, then do they add value compared with, say, 200 risk factors that you might have from some industries, for example, right? And the answer is that just based on numerology, intuitively, you could probably guess that the contribution of a small number of style factors is going to be relatively limited compared with something like 200 factors. But it's actually even worse than that, in a sense that style factors turn out not to be particularly good proxies for modeling correlations. Now, that deserves an explanation. So recall that, if I look at the factor model, if I look at the pairwise correlations, which corresponds to two stocks, in other words, the index I and J are not the same, and I calculate this pairwise correlation based on the factor model, the idiosyncratic part, or the specific risk part, which is diagonal, drops out. And so my correlations are basically approximated by a bilinear product of these factor loadings corresponding to the factors. So one thing you can do is you can ask yourself this following question. Suppose I take a style factor, call it beta I. And then just looking at beta I doesn't make a lot of sense, because you'll actually have to also include a style factor, which is, or just call it a factor, which is all ones. It's the intercept, basically. And the reason why you have to do this is because of the normalizations. For example, if I took one of my style factors that I had before, say log of the price. Now, I mean, when you say log of the price, well, price itself is something that is a dimensionful quantity, right? So it's measured in dollars. So it's never really log of the price. It's log of the price divided by some normalization factor, which if you take a log of something that's divided by something else, it basically shifts your style factor. And that normalization is completely up to you. It's basically not something that that's fixed from first principles. It's just an empirical question. Well, the real way of thinking about it is that, well, it's just the intercept. So you know, when you talk about one style factor, say log of the price, it's never log of the price. It's log of the price plus the intercept. Okay, that's why you have to include the intercept always. And so I can take this beta and this nu, which is the intercept, and I can build bilinear combinations of beta and nu. There are going to be 3 bilinear combinations. And I can say, well, are these bilinear combinations good proxies for modeling correlations in my sample correlation matrix? And even if I run that test in sample, out of sample, it's even worse, obviously. But even if I do this in sample, what you're going to discover is that these bilinear correlations involving style factors are rather poor proxies for modeling pairwise correlations. And that to be contrasted with industry-based factors, for which actually tends to be very good proxies for modeling correlations. But there's a reason for that, and the reason is very simple. If your industry classification is relatively well constructed, well built, then you expect that stocks within the same sub-industries, for example, or industries or sectors, they should be relatively highly correlated. And so, especially at the level of sub-industries, which is very granular, which looks at very granular properties of why one stock should be related to another. And I'll talk about those properties in a bit. So basically, there is a reason why industry factors should work as proxies for correlations. However, there is not all that much of a reason why these style factors or bilinear combinations of these style factors should be particularly good proxies for the correlations between different stocks. And so from that point of view, basically the message that I'm trying to get across here is that style factors are not the ones that one would like to focus in trying to build this kind of models. Actually, the industry factors by far outweigh them. And so if you were to ask me, I would focus on the industry-based factors and build those models properly ground up and customized to your to your particular trading models and to your particular quantitative trading alphas. So now I've been using this this term heterotic risk models all throughout without emphasizing it, and you know that's what these models are called. And so back in the day when I wrote that paper, a lot of people asked me, well, heterotic risk model, is that because of the heterotic string theory? Does it have to do with anything with heterotic string theory? Is it related to it? And so on and so forth. And the answer is twofold. So here's some trivia for you in terms of that terminology? The answer is twofold. That I personally got inspired to call it that using, based on heterotic string theory. However, heterosis has nothing to do with string theory per se. Actually, string theory borrowed that term from genetics. In 1914, this American geneticist, Shaw, invented the name, and it actually means hybrid vigor. So the meaning of that term in this particular context of risk models is that you're combining some powerful ideas such as factor models, industry classifications, and principal components into a construction that at the end of the day, as we will see, turns out to be quite powerful. So again, just as an illustration, I have schematically shown you what this heterotic Russian doll embedding looks like. So you start with a bunch of stocks, you break them into sub-industries, and sub-industries are combined into industries, industries are combined into sectors, and then at the last stage, you could get all the way to the quote-unquote market, which is your entire universe. So that very schematically, in a very pictorial binary manner, so to speak, shows you what this embedding looks like. So now, the final thing that I mentioned in terms of the ways of constructing these risk factors is based on machine learning techniques and clustering techniques. So you basically could say, well, if I can use these binary industry, if I can use these binary industry classifications such as BICS or GICS, then I can mimic that from the data itself by using clustering. So I take my returns data, I cluster it, I build something that looks like I'm classifying stocks into clusters, which are kind of like industries, and then I could actually, as a matter of fact, try to build a multi-level version of that. And then if I do that, then that looks like an industry classification, except that I'm not using any fundamental industry classification. And so the answer is yes, you can do this. It's a perfectly legitimate idea. And so in terms of clustering, you could, for example, use k-means, right? Which is a simple, quick way of clustering things. Now, one issue with k-means immediately that rises is that k-means is non-deterministic. Every time you run k-means, it's going to give you a different answer. And so from that point of view, you already know that because you're getting different clusterings every time you run things, there's some kind of noise present in the system. And so you want to reduce that noise. You want to see if you can reduce that noise in some fashion. And so there are basically three options that you really have in terms of reducing the noise. The first option is to aggregate a large number of clusterings. And that actually can be done itself via clustering, and I'll talk about this in a second. And this way you can construct multi-level clustering schemes where one clustering is embedded into another clustering, into the third, and so on and so forth. And then what you're going to do is you're going to take that clustering scheme that you're going to come up with, multi-level clustering scheme, and use it in lieu of the fundamental industry classification in the exact same way as I just described a couple of minutes ago in the heterotic risk model construction. So you basically don't need to do anything. Instead of using the fundamental industry classification, just plug in this clustering-based classification, and that's it. Everything else is already done, right? And so it's very convenient. It's kind of like a plug-and-play solution, except you don't have to go and pay for the fundamental industry classification, which costs money, right? Well, so that's one way of doing things. Another way of doing things in order to, at least in theory, minimize the noise is to say, okay, well, why do I have to take a non-deterministic classification scheme such as k-means? I could start with something that's deterministic, like hierarchical clustering. And, well, you can do this, and it's going to be deterministic. However, there are a couple of things to keep in mind, which is it's going to be slower because those algorithms typically take a lot longer to run. And then also it's subjective. It's kind of like non-determinism in disguise, because you can take a priori any hierarchical clustering, and in theory the number of them is infinite, right? Because like whatever you can find available, readily available out there online, that's only a finite number, the finite subset of the actual number of hierarchical clustering algorithms you could, in theory, construct. And so why take that and why not take something else? And so from that point of view, it's kind of non-determinism in disguise. So if you went through all of these deterministic, or a large number of deterministic hierarchical clustering algorithms, you would get a different answer every time you use an algorithm. And so from that point, it's kind of like the same as what you're getting with k-means. The third option is to aggregate a large number of risk models themselves, as opposed to aggregating the clusterings. And I'll talk about this in a second. So basically, you run a single k-means and you build a kind of like a incomplete version of a heterotic risk model based on a single k-means, and then you aggregate a large number of those. And what you get at the end of the day is actually not even a factor model. It doesn't factorize. But apparently, as it turns out, it also produces interesting results. So in terms of, let's start with k-means, right? So in terms of that particular type of clustering, or actually any type of clustering, you have to figure out what is it that you're going to cluster. So in k-means, you have some number n of d-dimensional vectors, and you minimize the within cluster Euclidean distance squared sum of those, and you have a large number of local minima. And the reason why the algorithm is non-deterministic is because you initialize your centers for each cluster, and these centers I call y's, y sub as. So these centers are initialized randomly on the first iteration. And so when you run the algorithm, you get a different answer every time. In other words, you find a different local minimum, and there is no way of finding the global minimum. And actually, within the context that we're talking about, finding the global minimum is not even clear why you would want to do that, because it's not clear that the global minimum would actually give you a better answer. So you get all these bunch of local minima, and that's hence non-determinism. The other question is, like, what is it that we should cluster, right? So the naive thing you could do is you could say, well, let me take my historical returns, and so my label S here is just the time label. It's the time series label. And so now that naive way of doing things is obviously not particularly, it's evident that it's not particularly efficient, because your returns have different historical volatilities and they're skewed. And so you want to get rid of that skewness. And so the machine learning lore will tell you, well, that's easy, right? Take your returns and then normalize them against the historical volatilities. So we already talked about these normalized returns are twiddles in the past. And so you normalize your returns and you cluster those. But as it turns out, that's not actually the most optimal thing to return to cluster. There's a better thing you can do, and you should be actually clustering not the normalized returns, but the returns divided by variances as opposed to standard deviations, with a little tweak that for small volatilities, you need to Windsorize your so normalized returns, because you don't want to have you don't want to overweigh the small volatility stocks either. And the reason for why this works better, and this has something to do with trading. It's not something that you would easily guess from the machine learning type of considerations. This is actually a quant trading intuition, so to speak, that goes into this. And so the reason why this works better is because you can think of the return divided by variance as the weights that you would get in an optimized portfolio, like mean variance or Sharpe ratio maximization. And that's why it works better, because these are basically your centers in your clustering are actually optimized portfolios, and it works better if you run the back test and so on. And so now in terms of the multi-level clustering, what you could do is you could try to construct these multi-level clustering schemes in two different ways. So when you're trying to do a multi-level clustering scheme, so you have, say, the number of levels, which is P, and that number will have to be fixed somehow, and I'll talk about it in a second. But you can do two things. You can do a bottom-up multi-level clustering scheme where you start with the most granular level first, and then successively cluster clusters. So, so you start, say you have 2,000 tickers in your universe, you calculate, you construct the first level of most granular level of clustering. So you have, say, 200 clusters, and then you successively cluster those clusters into less granular clusters. Another way of doing it is to do top down, which is you construct the least granular level first. So say you have 2,000 tickers, you construct 10 clusters, and each of them on average have 200 tickers in them, and then you successively cluster the tickers within each cluster to a more and more granular level. So these are the two ways of constructing these multi-level clustering schemes. The other way of doing it, as I mentioned, is to use the deterministic algorithms, such as agglomerative hierarchical clustering. If the number of your clusters K is not fixed, then you can use something that you can, like S-link or something like that, which you can borrow from what's available out there. If K is fixed, you can do other things. For example, you can use a relaxation algorithm in the paper that's mentioned there. And so, as I mentioned before, hierarchical algorithms, however, are slower and, as a matter of fact, subjective in the sense that it's basically non-determinate in disguise. And they don't really give you, in terms of performance, they don't really give you an edge compared with non-deterministic algorithms once the kind of aggregating clusterings and so forth that I'm going to discuss in a second is applied. So now the question then becomes, how do you fix these cluster numbers, K's, and the number of levels, P, to begin with? And the answer is that you can do two things, basically. One thing is you can use some kind of heuristics. Some of those heuristics, for example, are based on E-rank. So, to figure out what your K should be, you can use the effective rank the same way as you would do this in statistical risk models. And there's a variety of things you can do with that. Another thing you can do is, well, you could say, I'm not going to try to fix these numbers. I'm just going to keep them as hyperparameters, and I'm going to just go with that. I'm going to just try to fix them eventually through out-of-sample backtest and just optimize that way. So these are basically the two reasonable choices that you have in practice. So how do you aggregate the clusterings to get rid of that noise that I was talking about before? And the answer is that there's a way of taking a bunch of k-means runs. So you have a large number of k-means runs, and each of them produce a different local minimum, different answer. And so from each k-means run, you basically get a binary matrix, which tells you, okay, this ticker belongs to this cluster, and then it's 1, and if it doesn't belong to that cluster, then it's 0. So again, each run will give you a binary matrix like this, which is labeled by this small superindex, superscript R. And then you could say, can I aggregate these guys somehow? And so if you could somehow align the clusters to each other from different k-means runs, then you could say, okay, yeah, the way I'm going to do this is I'm going to build the aggregated non-binary matrix by just basically summing over these binary matrices. And then this non-binary matrix is not something that I want to have. At the end of the day, I want to have some kind of a binary matrix which will tell me this stock belongs to this cluster, which is the aggregated cluster. And so you could just say, okay, well, I'm just going to take, for each stock, I'm going to take the cluster in which it occurs most frequently, because this omega twiddle basically is the occurrence frequency for my ticker in different k-means runs, okay, for that particular cluster. And then there are going to be ties, and you can resolve them relatively simply. And so the big assumption there is that you have assumed that you are somehow aligning clusters properly. And the question is, well, I run the k-means, I run it second time, the two clusterings they look quite different. So how do I know which, I have the same number of clusters, but how do I know which cluster corresponds to which one? How do I align them? And there's a way to align them actually by looking at the centers that each clustering produces. So you take centers from each clustering. These Y's here are the centers for each k-means run. And then you can bootstrap these centers into a large matrix with basically m times k rows, where m is the number of runs that you have. And you can actually cluster that matrix itself using k-means. And that clustering will generate an alignment of the original k-means runs, the m k-means runs, into k clusters. Now, the little hiccup there, quote unquote, is that some clusters could actually be merged under that new clustering, And so at the end of the day, you might end up with a number of clusters which is somewhat smaller, usually not by a large degree, but somewhat smaller than the original intended number of clusters. And so you just, but that's just as well. I mean, it's not a problem. You just drop those empty clusters and you keep a smaller number. Basically, what that tells you is that your original number K that you wanted to cluster into was too large and you were overshooting. And so this alignment procedure actually gets rid of the junky, kind of noisy clusters. And so this way, you can align all the clusters, and then you can apply that procedure that I just told you in terms of identifying the aggregated clustering, and that you can use as your clustering algorithm, aggregated clustering algorithm at the end of the day. Now, you would immediately ask, well, I mean, if I'm going to use something like k-means to align the original clusters, then that itself is non-deterministic. So the final result is still going to be non-deterministic. That's true. The final result is still non-deterministic. However, it's a lot less noisy once you aggregate a bunch of clusterings than just using a single k-means. And so that's the benefit. As a matter of fact, you could eliminate the non-determinism altogether via a even more sophisticated algorithm and basically make your clustering statistically deterministic. However, in the context of risk modeling and quantitative trading, typically that would be overkill because at some point you're going to run into computational issues in terms of how much time you're going to run your programs for, how computationally taxing it is, and so you have to bear that in mind. And then basically the answer at the end of the day turns out to be that if you do what I described without completely eliminating the non-determinism, it's basically good enough. And then the final way of doing things is, well, okay, so you could say, do I really need to aggregate clusterings? What if I actually aggregate the risk models themselves? So the idea is very simple. You take a single k-means and you compute the model covariance matrix based on single k-means. Now, that by construction, that factor model is an invertible matrix. However, the issue is that the corresponding factor covariance matrix is singular because its rank is at most t-1. So if your lookback is small and your number of clusters is relatively large, then what's going to happen is that the factor covariance matrix is going to be singular. It's the rank of the factor covariance matrix is going to be at least t-1. So even though you have, say, 200 clusters, your factor model that you have constructed this way actually, in disguise, is only a t-1 factor model. So you're covering only t-1 directions in the risk space. Here's where the aggregation helps, because when you calculate a risk model based on a single k-means, it covers some t-1 directions in the risk space. When you run another k-means, it actually covers a different t-1 directions in the risk space. And in many cases, it can be quite different. So when you aggregate a large number of these, you're covering a lot bigger chunk of your risk space via aggregation. And so basically, once you aggregate a relatively large number of these single k-means based risk models, you get a model that at the end of the day is not even a factor model. It doesn't factorize. It doesn't have a factor model structure. But the properties of these kind of risk models is that they cover a lot more of the risk space, many more directions in the risk space that a single k-means would cover, and they're perfectly invertible, so you can actually use them in your optimization and quant trading. And so at the end of the day, the performance of these aggregated risk models is actually comparable. It's very similar to the performance of the risk models based on aggregating clustering. And that, in a way, is a good thing. It's actually a confirmation that what you're doing is reasonable, because you do things in two different ways and you get basically the same kind of answer. So that's a good thing. Now, so let me get to the bottom line of this. And you're sitting there and you're probably thinking, okay, well, this is all great, but you've described at least three different ways of doing things. And so which one is the better one and which one is the worst one, right? So here's the answer. If you run a horse race, what you're going to discover is that the statistical risk models based on principal components are worst performing. The reason for that is because they cover a relatively small chunk of the risk space, and principal components outside the first one are relatively unstable out of sample. Machine learning risk models, the kind of risk models that are based on clustering and so on, do better, substantially better, because you're actually covering a lot more of the risk space, and you're uncovering some kind of relationships between the returns that are not there on a linear level. However, they actually underperform the heterotic risk models based on fundamental industry classification, and there's a substantial difference. So basically, you could say that humans, meaning the fundamental industry classification, still beat machines at this point. And so in that regard, I want to point out that the fundamental industry classifications are based on humans doing a certain type of analysis, which takes into account a lot of different things, which is the sources of revenue of companies, their customers, partners, suppliers, competitors, and so on and so forth. And a lot of that information comes from relatively unstructured data by reading 10 Qs and Ks and some other sources of information. And a lot of times, the final decision in terms of how to classify things boils down to a judgment call. And sometimes those judgment calls by human analysts are not correct. However, on average, they're still better than what you can extract from the returns directly. So in theory, you could say, well, the returns already have all this information encoded in them. It's a matter of extracting it. And the answer is yes, it's just a matter of extracting it. However, it's challenging. And the reason why it's challenging is because it's your standard low signal to noise ratio problem. So by applying machine learning techniques, you can extract some part of that signal, but it's difficult to extract all of it because the noise is quite large. And so that's what it, at the end of the day, breaks down to. And so the open question is, can you build a machine learning algorithm that will basically outdo the humans? And by that, I don't mean just replicate what humans do, because if you build an algorithm that kind of replicates what the humans do by looking at the revenues and customers and partners, all this other stuff, as opposed to, in other words, fundamental data, as opposed to just the returns, then that will just do at best as well as the humans do, maybe a little bit worse, because the judgment call is still it's going to be difficult to figure out. But can you build something better than that? And then that's not, it's unknown at this point whether you can. Maybe you can at some point. So let me finish with just a very quick comment that there's a bunch of literature that you can see cited here, and that literature contains a lot of R code for constructing the risk models, R code for backtesting, and so on and so forth. So if you're interested in the subject that I've been talking about for the past 1 hour and a half, and you want to get the kind of more hands-on experience with it and run some back tests and so on and so forth, you can do that. And there's a lot of stuff out there, meaning including the source code. You can go there, you can download these papers, get the source code, adapt it to your trading strategies. You can pick some short horizon alphas, optimize them using these 3 different constructions, and see for yourself which one worked better, which ones work better, and which ones work worse, and so on and so forth. And that way you can basically, it's kind of like a way of getting your hands dirty with this stuff. And so at the end, I have actually given all these the links to all these papers that you can actually download. Okay, so I'm going to end right here, and thank you for listening. I will pass I'm going to pass this back to the organizers and see what kind of questions there might have been asked in the interim.
Thanks a lot, Zura, for such an insightful session. And I sure learned quite a bit. I would like to talk about few initiatives of Quantitative that might be useful for a few participants here. Our flagship course, Executive Program in Algorithmic Trading, EPAT, is the world's first verified certification offered to professionals looking to enter or grow in the algorithmic and quantitative trading industry. We also launched an interactive self-paced learning portal, Quantra, offering 20 plus courses. With the vision of becoming a global knowledge and technology powerhouse in this domain, we also launched Quantra Blue Shift, which is in its alpha stage and allows you to convert your ideas into strategies and backtest them for free. Now I'm going to end the webinar. Have a great rest of the day, everyone, and thanks for joining in. Thank you so much.